Hello dear students and welcome to the class of Principles of Microeconomics Econ 111 lecture number 16, and today we are going to continue with the government policies that we started yesterday. But in yesterday's lecture we discussed about the price control mechanism, that is when government imposes a price ceiling or when government imposes a price floor. And we have seen its impact that it is not usually good for the economy or for the market. So today we are going to see how taxes can impact the market. And when we talk about taxes, we are not going to include the income tax and all the corporate type of taxes, but we'll only include those taxes that can impact the market directly, that is taxes on the sale and purchase of goods and services, and we call those taxes the sale tax. So let us begin with this lecture. Now, taxes are the main revenue source for a government. Government generates revenue through three major sources, and one of them is taxes. The other two you may call them as borrowing from the general public or from the banks. And then finally the government also generates revenue by printing money. So we are only going to focus on taxes and how it impacts the market. And again, when we talk about taxes, we are only going to refer to the sales tax. So the government are able to impose tax on the buyers and sellers, and usually the sale tax is collected to the sellers and they pay it to the government. But then who actually is paying for those taxes, whether those taxes affect the sellers or whether those taxes affect the buyers? That's an interesting question. Who is paying those taxes? Because it is included in the overall purchase amount. Certain value may affect the buyers, but in many other cases the sellers are only affected. So what can determine the tax incidence, that who is paying more? And we are going to learn that in today's lecture. Then there are types of taxes. Taxes can be either a percentage of goods, and when we impose such type of taxes, they are usually called ad valorem taxes, that is taxes imposed on the value of good. And then there are other types of taxes known as specific tax, that is imposed on the unit sold. For example, if you sell 100 units or 100 barrels of petrol, for let's say, whatever the price may be, you will have to pay a certain amount of tax, right? So one is related to the value of the good and the other is related to the quantity of the good. And we will see what type of tax we are talking about in the supply and demand infrastructure. So for simplicity, we are going to, for this purpose, we are going to analyze the per unit tax. We are not going to study the ad valorem tax. Now here is a typical supply and demand analysis for the market of pizza, and we have S1 as the supply curve, and we have the D1 as the demand curve. So what are the equilibrium prices and quantities? Let's identify them. The equilibrium price here is $10, and the equilibrium quantity, the number of pizzas sold and purchased, is 500 units. So this is without imposing any taxes. Now, what if we impose tax? What if the government imposes tax in this situation? What will happen? Now, let's say the government imposes a tax on the buyers, and what will happen when a tax on the buyers is imposed? the demand curve will shift back because now things will get a bit expensive for them. So here is the shift. Tax on the buyers shifts the demand curve down by the amount of the tax, that is by $1.5. So you see, there is a tax wedge, this green line. In economics terminology, this is called tax wedge because it looks like a wedge in the supply and demand, and the demand curves shift exactly down from the blue line to the red line by an amount of 1.5 dollars, right? So now there will be new prices and new quantity. The new price that the buyers are paying, now that price is equivalent to the line on the blue demand curve, the D1, whereas the suppliers are actually getting is on the new equilibrium, and this difference that we know is equal to 1.5. So the supplier are now getting less than $10, which was actually the market price. Now they are getting less than the market price, whereas the buyers are paying more than the market price because they are paying taxes as well. So what is the overall impact? What are the new prices? Let us introduce the new prices. The prices the buyer pay rises, and the prices the seller gets falls, and the new prices are $11 for the buyers that we have denoted by PB, and that is $9.5 for the sellers. So there is a difference of $1.5 between the price of the buyer and seller. And where is that 1.5 going? That is going to the government's revenue. Right? Now we need to understand who is paying more in this situation. If you look at the values, the market price was 10, but the buyers are paying 11. So they are paying $1 more than the market price. So the actual tax effect on the buyers is $1. But because these products, because of the tax, these products are now expensive, so their prices is automatically high for the buyers, so they demand less, and because of the less demand, suppliers are not able to sell the products. They will charge lesser prices. So instead of charging 10, they will be charging 9.5, right? So price has gone down for the supplier and has gone up for the buyers. So the supplier basically paying $0.5 as a tax, whereas the consumers, they are paying $1 as a tax. Now the quantity has also declined, has reduced in this market. Previously 500 units of pizzas were sold. Now only 430 units are sold. So there is a decline in the overall products that are sold in the market, and this is not good. Usually for economy to grow, we need to have more transaction, more goods to be purchased and sold. Overall, in the economy now 430 units are traded, 430 pizzas are traded instead of 500 pizzas. So this is how a tax can affect the market. Now, what was the tax incidence? How the tax is shared among the market participants? Let us have a look at that again. In the overall $1.5 tax, $1 is being paid by the buyers and $0.5 is being paid by the seller, and this is now clear from our discussion. Now we need to understand it from a different perspective. In previous example, we imposed a tax on the buyers. Now what if the government imposes the tax on the sellers, that not the buyers will pay the tax, but the sellers will pay this tax. So if a tax is imposed on seller, the cost rises for them. And when cost rises, we know that supply curve will always shift backwards. So in this case, if you look at the graph, S1 will shift to S2. And now the new supply curve is the red line. And this is now the price that the consumers will pay, right? But what actually the supply receive is the red line that is below $10. And again, if we introduce the values, the price the buyer pay rises, the price the seller receives falls, and the price the buyer pays 11 and the price the seller pay and gets is 9.5. So this is very much identical to our previous example. It means the main idea here is, the main takeaway here is that whoever the government may impose the tax on the buyers, the government may impose the tax on the sellers. The overall result will always be the same. Market will be distorted in the same manner. Again, if you look at this example, even though the tax was imposed on the seller, but they do include this in their cost, and so they raise the price, and when they raise the price, then the overall demand will reduce. So because of the decline in demand, the new price will also go down slightly by 0.5, so that the buyers are only paying $1 in tax, whereas the suppliers are paying $0.5 in tax. And again, it does not changes the overall result on the market quantity. In the previous example, the market quantity was for 30, and similarly in this example, the market quantity again is 430. So what we get from it is the outcome is the same in both cases. You impose a tax on the buyer, you impose a tax on the seller. The outcome is the same. There will be a wedge created and the incidence will fall identically in both the cases. $1 is paid by the seller, $0.5 paid by the $1 is paid by the buyers and 0.5 is paid by the sellers. So a tax drives a wedge between the price buyers pay and the price the sellers. Now let us see if you can do this yourself. We take the previous example, the market for hotel rooms, and we have the supply curve, we have the demand curve, and now you can see the equilibrium price, that is the equilibrium rent, that is 100, and the equilibrium number of rooms, that is 100. But the question for you is that suppose there is a tax of $30 in this economy. So how will this affect the overall prices, the price for the buyers and the price for the sellers, and then the equilibrium quantity? So can you find it from this graph? And also, can you say that who will be paying how much tax, whether the buyer will be paying more tax, whether the sellers will be paying more tax, and how much tax are they going to pay? By this I mean the tax incidence. You can calculate the tax incidence. So try it, pause the video and see if you can do this, and I'm going to tell you the answer in a while. Here is the answer. A tax amounting to $30. This cap is exactly equal to $30 because you can easily see 1 bar or 1 square equals to $10. So a $30 tax incidence, a $30 tax wedge will lie where the quantity is 80. And how will this impact the buyers? How much amount the buyers are going to pay? This is 110. You can extend it and see that the buyers are now going to pay 110 instead of 100, whereas the sellers are going to pay 80 instead of 100. Now, if you compare it to the previous example that we have done, in that case, buyers were paying more, sellers were paying less. This raises another question. The question is, how we know who is going to pay more? Is there any criteria? Why in some cases buyers are going to pay more? Why in some cases the sellers are going to pay more? So this is an interesting question. Who is going to pay more when you want to apply a tax on certain types of markets? Can you tell who is going to pay more? So for that purpose, we need to introduce the concept of elasticity. We already have discussed elasticities, but basically who pays more depends on who respond more to a price change, and that means the elasticity. So let us see how elasticities work when we are imposing such type of taxes. Here is the elasticity and tax incidence. Supply is more elastic than demand. You see two cases. Demand curve is having a greater slope. That means that when price changes, there is a little change in quantity demand. So the demand curve is inelastic, but the supply curve is more elastic, and the price in this economy will be as identified here. The equilibrium price will be at this point, whatever the value is, and that is price if there is no tax. But what if we impose a tax in this economy? So if we impose a tax in this economy, this will be our tax incidence. Let me remove the lines. This is our tax incidence, and you can easily identify that buyers are paying more as compared to the sellers. Next case, this is the PS, price the suppliers are paying, and this is the price the buyers are paying. So buyers are paying more as compared to the suppliers. So buyers' burden of the tax is more as compared to supplier. In this case, we can say that when demand is inelastic and supply is more elastic, the one which is inelastic is going to pay more. This is our second case. Now the demand is more elastic and supply curve is inelastic. See, so what will happen when demand curve is more elastic, supply is inelastic? This will be our equilibrium price, and this will be the tax wedge. How will the tax burden be shared? In this scenario, we see that PB and the PS, we can see that now the suppliers are paying more tax as compared to the buyers. So the conclusion is the burden entirely depends on the elasticity of the supply and demand. If demand curve is more elastic than supply, then the tax burden will lie on the seller, but if demand curve is less elastic than supply, then the tax burden is going to fall on the suppliers. In short, if we are studying a market where necessary goods are traded, or where short-run economies are studied, in all those cases, the tax burden will be borne by the buyers. But if you are talking about luxury goods, In that case, when we are studying luxury goods, the market for luxury goods, in that case, a tax burden is usually shared by the supplier. So, hope you understood this example. This is the conclusion of our discussion. If buyer's price elasticity is greater than seller's price elasticity, buyers can more easily leave the market when the tax is imposed. So the buyers will bear a smaller share of the burden of the tax than seller. And if the reverse is true, if the seller's price elasticity is greater than the buyer's price elasticity, in that case, then we will see the reverse, the tax burden will be shared more by the buyers. Let's discuss the application, the real life application of what we have studied so far. There are certain rich people who buy very expensive and luxurious products. For example, they buy expensive cars like Mercedes and BMW, or they buy yachts or private jets. So there are certain type of people, they can afford these commodities and they are luxuries. Now government can generate revenue by imposing tax on such type of people. So should the government apply, or should the government impose a luxury tax on these goods? Let's say if they do, what will be the impact of the economy? Generally, we think that it is okay. They are rich people and they have excess amount, and it is good to let them pay the luxury tax. But in reality, the tax may affect the sellers more as compared to the buyers. Why? Uh, there was a scenario in 1990, the American and USA, the Congress adopted a luxury tax on yachts, private airplanes, furs, and expensive cars. And the purpose of this tax was to collect revenue from the rich people. But what happens, we can see that the goal of the tax was to raise revenue from those who could most easily afford to pay, and that is the wealthy consumers. The result of this was a reverse. Who will actually pay this tax? We can see that here is the demand curve for, let's say, yachts, and that is a luxury good, and the supply curve for yachts, that is comparatively, you can say it is comparatively inelastic to the demand curve. We know that the demand curve for luxury goods is usually elastic. So what is the equilibrium price and equilibrium quantity? Let us identify that first. This will be the equilibrium quantity. Let me use the highlighter. This will be the equilibrium price, but when you impose a tax on these yachts, the price the buyers will pay will rise slightly as compared to what the price it becomes for the seller. So the tax burden that is shared by the sellers, here the buyer's share of the tax and here the seller's share of the tax. The goal of the policy was to tax the buyers, but actually it is the sellers who are going to pay the tax. So therefore such policies must be devised carefully. So what do we conclude from this discussion is that each of the policy in this chapter affect the allocation of society's resources, and that is if we impose a price ceiling, it again affect the allocation of resources. In most cases, the quantity sold or consumed in the market is reduced than the equilibrium quantity. In the first example, a tax on the pesa reduces the equilibrium quantity of pesa, and the resources allocation suffers because now the suppliers will allocate less resources for the production of pesa. Then since the economy is producing fewer pizzas, some resources such as workers, oven and cheese will become available to other industries, and there will be an excess supply over there. Another example, that was a binding minimum wage. When there are laws such as the minimum wage laws, it causes surplus of workers, and again it's a wastage of resources. You have excess labor and the labor is doing nothing. They are not taking part in the productivity. Hence the overall gross domestic production of the economy declines. So it is very much important for the policymakers to apply such policies very carefully. In general, a policy may look very attractive, such as when we are imposing a tax on EHS. It apparently seems attractive as we are taxing the rich buyers, but actually the effect moves on to the producers rather than the buyers. So that's the end of the chapter. Hope you have learned and enjoyed this session. If you have any question, please do ask in the comment section. Thank you very much.